In the last lecture, we have seen how butterfly strategy basic construct looks like. Now let's go a little bit deep into long call butterfly. So here in this lecture, I will take an example and I will also explain what is the kind of basic formulation will be there in terms of the strike price selection. In the next lecture, we will see more about the key metrics, etc. related to long call butterfly. If we see basic construct of long call butterfly, first you will buy one in the money call option and then you will sell two at the money call options and finally you are going to buy one out of the money call option. So effectively it's a three different positions, but the quantity wise if you see the sell positions both are at the money are very close to at the money and the buy positions will be in the money and out of the money. One of the reason why you should go for in the money buy and then at the money sell and then out of the money buy is if you go for in the money, the time value which you are paying for this position will be less. Automatically your debit will be reduced. So that is the reason why rather than going for one at the money, two little out of the money and one more out of the money. This strategy, this is the normally used variation where you will go for in the money buy, two at the money sell and one out of the money buy position. Of course, when you say at the money, it may not be exactly at the money. It will be very close to at the money kind of position we are going to take it. And if you observe one more thing, this looks like a combination of bull call spread and bear call spread. So those of you who are not aware about a bull call spread and bear call spread, what is a bull call spread? In case of a bull call spread, you are going to buy one call option which is, let's say, a lower strike call option, and then this you are going to buy, and then you are going to sell higher strike call sell. So lower strike call by higher strike call sell. So if you see this, if I divide this 4 into 1 in the money buy, one in the money call option buy, and one at the money call sell position. If you see, this is nothing but lower strike buy, higher strike sell position. So this is nothing but an example of a bull call spread position. And what is the other two positions? We are talking about one more at the money sell position, call sell position, and one out of the money call buy position. So this is nothing but a combination of pair call spread strategy. Of course, the strike price which you select can vary. Generally, for bear call spread, you will try to go for little out of the money sell and far out of the money buy. But if you see the construction wise, it looks very similar to a combination of one bull call spread and one bear call spread. So you can understand butterfly strategy as a combination of bull call spread and bear call spread. If you bifurcate those four positions in this way, you can understand very easily. One more key feature is the spread width will be same. Whether you talk about a bull call spread or bear call spread individual positions, that means the difference between the strike prices of in the money and at the money will be same as at the money out of the money. You will understand clearly when I show this below example. I have taken the data of Nifty on 6th July 2021 when it was trading at 15,818. One of the ways to construct a call butterfly strategy as below. So if you observe this strategy, what we are doing here, 15,700 we are buying, which is in the money. 15,900 in this case it's not in the money, it is little out of the money, but very close to the current value. And the other one which we are going for by is 16,100, which is more out of the money position. And if you observe one more feature here, the width between this is 200 points. The width between these two strike price is also 200 points. So we are going to maintain the same width between the buy position and the sell position. Similarly, the sell position and out of the money position. So there is no hard and fast rule that you have to go with same in the money, at the money, or out of the money. You can try to move the strike price little bit far also, depending on the view you have. But generally, when this strategy works, this is the debit strategy. If you want, you can clearly see here 251 you are paying, 62 also you are paying. In return, you are going to get 142 multiplied by 2 because 2 large sell position. Effectively, it's a debit position. In the next lecture, I will explain you in detail about the calculation so that you can clearly see the risk and reward. So when you are starting with a debit position, automatically when you're talking about the bull call spread, bear call spread combination, which is nothing but the butterfly, it need to be in a certain range, then only it will be profitable. So these are some of the key points you need to understand. In the next lecture, I will focus more on the risk, reward, and break-even points. So then you can understand exactly when you should go for this strategy.